Good morning, and thank you for the opportunity to address these esteemed committees. My name is Todd Del Porto, and I recently joined Fremont Bank as the Senior Director of Strategy and Growth for the Residential Lending Group. Though I'm new to Fremont Bank, I have 30 years of residential lending experience following my graduation from Santa Clara University. During this time, I held several prominent senior leadership roles with a national scope and focus in both residential and wholesale lending. I'm a proud lifetime California resident, having enjoyed time in both Northern and Southern California. And as far as my testimony is concerned, I'll speak more as an industry veteran versus solely from a Fremont Bank perspective. Fremont Bank is a locally owned and operated community bank, having recently celebrated our 50-year anniversary. The bank's primary focus is to combine exceptional relationship-based banking services with competitive lending solutions in strong partnership in the communities we serve. The residential lending group that I'm part of is comprised of two primary lending channels: a retail organization that serves consumers primarily through a call center operation and through a number of relationship loan officers that serve our bank branch footprint, which is exclusively at this time in the Bay Area. Our second lending channel is a wholesale lending channel that makes loans to consumers, but indirectly through mortgage brokers that are bank approved and monitored, and we do that throughout the state. Generally speaking, our product offering and mix of business is similar, and each channel represents half our business. I'd now like to turn my attention to some of the federal programs and policies to support first-time homebuyers. As you've heard and understand, key markets in California can be characterized as having a severe shortage of quality, affordable housing, while at the same time there is strong consumer demand and exceptionally low interest rates. The result is an incredibly competitive purchase market, often referred to as a seller's market, leading to multiple offers and in many cases well in excess of the list price. In addition, it's often the strongest offer, a blend of price and terms, that wins, and that's accepted by the seller. These dynamics make it even more difficult for first-time homebuyers to have their offer accepted, as many are reliant upon low down payment, high loan-to-value financing that typically require private mortgage insurance or FHA financing. Another important dynamic that puts first-time homebuyers at a disadvantage is that there are arguably no special federal programs or policies, such as down payment assistance or tax credits that my colleagues just spoke of. Furthermore, affordable housing that might be suitable for first-time homebuyers is also often attractive to investors who often make aggressive all-cash offers. So, as we know, the macroeconomic environment is challenging. Broadly speaking, the industry offers three primary alternatives for first-time homebuyers. The Federal National Mortgage Association, referred to as Fannie Mae, and the Federal Home Loan Mortgage Corporation, referred to as Freddie Mac, have historically offered financing up to 95% loan-to-value for first-time homebuyers and non-first-time homebuyers with private mortgage insurance. To manage my time, I'll speak only about Fannie Mae since the product offerings are similar. Fannie Mae has also offered a 97% loan-to-value program with only a 3% down payment, known as My Community Mortgage. The program requires the following: that at least one of the buyers is a first-time homebuyer and has attended a homebuyer education course, and that borrower income cannot exceed 100% of the area median income, or in some cases 115% in non-metro or certain high-cost areas. However, this program is limited to a maximum loan amount of $417,000, which means that the maximum home price could be just under $430,000, and that ties back to something Professor Bostic spoke to earlier. In December of last year, Fannie Mae introduced a 97% first-time homebuyer program without income restrictions and without the need to attend counseling. However, the cost of this program is higher as the mortgage insurance requirements are more stringent, and that, in the end, limits the borrower's ability to qualify. Moving to the second main option for first-time homebuyers is the Federal Housing Administration, or FHA, presently offers financing up to 96.5% loan-to-value, requiring a 3% down payment, with their own version of mortgage insurance referred to as MIP. However, this financing is also available to non-first-time homebuyers. Finally, the Veterans Administration, or VA, has historically offered financing up to 100% for qualified veterans. Beyond these programs, many major lenders and mortgage insurance companies have training and tutorials normally available through their website, but in some cases through in-person, local market training to educate and prepare first-time homebuyers. Yet of note, these are private efforts and not as a result of government sponsorship or funding. I'll now explore each of these in a little bit further detail. Fannie Mae and Freddie Mac, generally speaking, offer what is known as conventional loans. And for a first-time homebuyer with high credit, the most qualified of first-time homebuyers, low down payment conventional loans may offer the lowest mortgage payment when you compare the interest rate and the cost of mortgage insurance versus an FHA option. Mortgage insurance on a conventional loan may be canceled upon borrower request under a number of qualifying circumstances. And virtually every lender offers these programs, where not every lender offers FHA and VA due to some of the complexity and the need for specialized resources, such as underwriters with special authority. Generally speaking, FHA loans may benefit borrowers by offering a low down payment and more lenient credit guidelines. To help stimulate greater usage of FHA, especially for first-time homebuyers, as Mr. Collins spoke to earlier, the FHA did reduce the annual mortgage insurance premiums by roughly 50%, leaving the upfront premiums unchanged. However, a prior change that occurred roughly a year or so ago, FHA mortgage insurance, again known as MIP, cannot be canceled. In most circumstances, must remain with the loan for its lifetime. VA loans are less common than both FHA and VA, yet they're desirable for qualified veterans, those who have earned and possess what is known as a VA entitlement. This is the amount of financial guarantee that the VA will offer the lender in the event the veteran defaults, and it's typically 25% of the loan amount. Benefits of VA loans include no down payment, no mortgage insurance, and more flexible credit guidelines similar to FHA. The challenge with VA loans is as follows. Instead of mortgage insurance, there's a VA funding fee that is normally financed into the loan amount. So the loan to value would be typically north of 100% loan to value. And also, sellers are not always supportive of VA financing since there is no down payment and due to misconceptions about how the product and process works. Now I'd like to briefly summarize. Though there are state programs and policies designed to support first-time homebuyers, and some of them, as my colleague testified, work in conjunction with what is offered by Fannie Mae, Freddie Mac, and FHA, there are few special programs and policies available at a federal level other than what is commonly available in the marketplace. Both Fannie Mae and Freddie Mac have first-time homebuyer programs with only a 3% down payment, yet they are limited to a maximum loan amount of $417,000, and they have maximum income restrictions. FHA and VA both offer high loan-to-value financing that will support higher loan amounts, such as up to $625,500. Yet this type of financing is often not appealing to sellers who prefer a larger down payment, shorter close of escrow, and may be biased against the first-time homebuyer as the perceived risk of the transaction not closing is higher. Thank you for the opportunity to address this important topic.
Mr. Della Porto, thank you so much. We'll now open it up for questions to any of my colleagues. Chairman.
I have one for Ms. Patterson. For individuals who do not qualify under any of the programs offered by CalHFA or HCD for that matter, what do you foresee some of their obstacles or challenges are? Do you see a trend for this particular population?
Those that aren't qualifying, it is because they're either over income, they're not credit worthy, or they're not meeting the minimum FICO scores that are required for our programs. Now, what we have been doing is we've been working with HUD credit counselors and to help them get their credit ready. We've been also doing home ownership workshops and financial literacy. I think one of the questions was about that, working with them and referring them to those folks so that they can get credit worthy. But those that we are seeing that aren't qualified, it is because either their incomes are too high or because they're not meeting the 120% AMI that we are, low to moderate incomes that are our targets, or it's because of their credit scores. I don't know that I see any real trends other than those probably two big ones. And Ken.
Yes, good morning. My name's Ken Giebel, and you have two Santa Clara grads talking to you about home ownership. Interesting. We have a program where a borrower will call us. We call it our LEADS program, and it's an 800 number, and they call us, and they come in, and as Tia said, we ask them the questions. We have a qualifier tool, and the first thing we ask them is their income, and then we will talk to them a little bit about their FICO scores, but we can't really help them in that we're not a direct lender. So what we do is we have a list of 50 preferred Cal HFA loan officers across the spectrum, and we send that borrower, potential borrower, assuming their income's okay within the limits, and we send it, and in 48 hours, that loan officer gets back to that borrower and answers their questions. Oftentimes, they're not creditworthy yet, and they'll put them give them a HUD counselor, or they'll tell them to go on. We have an online home buyer education course that is financial literacy and home buying, and it's knowledge-based, so you kind of have to go through the process before you can get to the next sell, and that's kind of where we start with them. But we do take them and get them into the process so they can start figuring out how to do it. They typically don't know very much. Even the millennials don't know very much. So
just to follow up on that, what is the cap for income in terms of the limit where you can still qualify for one of your programs? And do you also obviously then have a floor that you have to meet a basic requirement of income to be able to afford the home?
Our income limits are at least 120% of the area median income set by each county, and those numbers are come in via county. In Sacramento,
Can you just give me an example for like Sacramento?
Sacramento, it's $99,000
for an individual or family?
for a family.
What if it's just a single individual? Does it matter?
Twos and threes and fours.
2, 3, and 4. Yeah, a two household, member household, and 4-member household. The 4-member household, the highest income limit would be $99,000.
Also, okay.
Yeah. So that.
And then if you were talking about that, so if you had like a single individual, it'd be less than 99, significantly, slightly.
Is that right? If there's only one person on the loan? If there's only one person on the loan, the
number of residents. So there's we have them 1 to 2, 3 to 4, and 4 and above by each county, and that's based on those area median incomes. We get the numbers from the feds, and then we have to do a formula with HCD and figure all that out because it's across the CHDAP programs and it's across the first mortgage program.
So Los Angeles County would be probably higher. It's less.
Oh, actually, Los Angeles County is less.
And
I want to say they're like around 78,000.
Where would that put like the Inland Empire?
About 78.
Okay, so that's good to know. So just to follow up with that, I would love to partner with you guys in the future to help more of my constituents and hopefully future homeowners in my area know about your programs. Are you doing a lot of outreach? Are you doing marketing? Should we be providing more help with that?
Yes. As a matter of fact, I think we had conversations with your staff about potentially doing some linkage or some town hall meetings and get out the word.
I would look forward to that. And finally, very last question before we move on to the next panel, Mr. Della Porto. Just to be clear, and I worked, as you know, I think from my earlier comments, for nearly a decade with one of the co-sponsors of the conforming loan limit. It was one of the things I worked on, and unfortunately we did not increase the limit or keep the limit higher for a number of other avenues besides FHA. But just to be clear, I was a big supporter when the President and Mr. Watts made the very, I think, smart decision to lower the actual amount of PMI having to be paid. But is it correct from what you say, both Fannie and now in FHA, the mortgage insurance is not cancelable after a certain period of time, even when they meet a 20% threshold of worth or value in the house?
In most cases, let me bifurcate the two, and then I'll start with FHA. In most cases, except if the product term is less than 30 years or there's a large down payment, which is uncommon with FHA financing, the mortgage insurance premium is for the life of the loan. And the way that it's removed typically is when there's enough equity in the home, the consumer is forced to refinance into, say, a conventional loan. And frankly, that's happening at some frequency given the increase in property valuation. On the conventional side, there's a variety of circumstances. But if the consumer requests it within 2 years and the loan to value can be evidenced by an appraisal below 75%, it can be dropped. After 5 years, if an appraisal will show that the value is at 80 or less, it'll be dropped. And if they never request, automatically when the loan amortizes to 78% loan to value, the lender is required to automatically drop it.
That's usually between 5 and 10 years for that situation.
Yeah, correct.
So for the first situation, I had a FHA loan. After about 2 years, interest rates were a little bit lower. I clearly had more than 20% value. I refinanced. There was no issue with my situation with my PMI. Going forward, if interest rates go up to 5.5%, 6%, you're at a 4%, you're going to now have a very difficult decision because you could get rid of your PMI, or in this case, it's MIP, but now your interest rate is up 2 points, and you're looking at the difference. You're basically just going to have the same payment. You're just going to be paying it towards interest. And I think I heard you say, did you say that, and this will go to, excuse me, forgetting your name, Ms. Hall, that PMI is at the federal level, you're able to deduct it? Because I didn't think that was the case when I had it.
Yes, you can deduct PMI for federal tax purposes, but not for state.
Is that a recent development?
I don't think so. I think it's within the 5 years or 6 years.
What I read recently is that it was deductible at least through 2014, but there's an income phase out.
Yeah.
Above 109,000,
That's
it's
correct.
not deductible. So up to 100,000, it's fully deductible. It's phased out between 100 and 109. So in some cases, though deductible, there's some limitations.
Yeah, it was extended in the 2014 extenders that happened late December of 2014.
I appreciate it. Thank you so much.
I have a quick follow-up for Calec Gervais. I believe that one of your first slides indicated that since 1975 you've served 150,000 clients. What are some of the resources that you would need in order for you to serve even more?
Our down payment assistance that was provided through the bonds, like I said, we're on our recycled funds of those monies, but the initial allocation of those proceeds that we were using for down payment assistance is going to be gone by the end of this calendar year. And so we did notice that down payment assistance is one of those things that you could target and help this particular population. Now, in addition to our down payment assistance we offer, we do have that's extra $6,500 that we offer, which we call our ZIP program, which we use some program income to marry that with that. And we use that $6,500 to either pay the mortgage insurance premium up front so that we were reducing the actual monthly amount that borrowers are paying. And that was extremely helpful to our programs. When we introduced that extra ZIP or zero interest payment along with our down payment assistance, we really saw our mortgage products take off, and that was September of 2014, I want to say. And last year, our last month for February, we saw our lending hit where we lent $50 million for the month of February by some of the programmatic changes that we have made with our products.
That's great. I think with that, we'll move on to the next panel. I'll turn it back over to Chairman Chow.
Thank you. At this time, I'd like to invite the next panel to join us at the desk. And the speakers are Mr. Mark Astorios, Rios, Executive Director from the Irvine Community Land Trust, Mary Ann Gato, Chair of the Irvine Community Land Trust, and also Carol Ornelius, CEO of Visionary Home Builders. And they are going to provide us with an overview of alternative homeownership models. Thank you for joining us, and you may begin.
Well, thank you, Honorable Chair Chow and Honorable Chair DeBobney and committee members. My name is Mary Ann Guido, and I am Chair of the Irvine Community Land Trust. I'm also a former Irvine City Councilwoman and a current Planning Commissioner, and I've been involved with keeping housing affordable in the city of Irvine since its incorporation. With me today is our Executive Director, Mark Astorius, and I thank you for allowing us to testify. Our presentation will provide the background and explanation of what is a land trust, how is it structured, the benefits of this best practice model, and what's happening in the state through this national growing model. So as you can see from the map, we have national land trusts throughout the country. The Irvine Network is part of this national network, and we have 120 members that include community land trusts, representative nonprofit organizations, and local governments that are working to create permanent, affordable home ownership opportunities in their communities. And so the Community Land Trust is a nonprofit corporation that develops and stewards affordable housing and other community assets on behalf of a community. The land trusts are generally newly created nonprofit organizations with geographically defined service areas and with membership open to all area residents. And some land trusts are part of an existing nonprofit organization, some are operated by cities, such as ours, or counties. And the classic community land trust uses this tripartite governance model, meaning it includes community members, homeowners, leaseholders, public stakeholders in equal numbers. And so typically our land trusts focus on low and moderate income households and providing affordable home ownership and opportunities. So as you saw on the last slide, this model crosses the country, but we have several home ownership land trusts in California. The Irvine Community Land Trust was established in 2007 as a 501c3 when there were only 3 other land trusts, and today there's 120 national and 15 members are within California. And you can see that they represent a geographic region up and down the state, from Humboldt to San Diego. We've created over 2,600 permanently affordable homeownership units. And the California contingency of community land trusts is networking among ourselves. We advocate for legislation that supports permanent, affordable housing in California. And so, of course, we thank you for this opportunity to present this to you today. As I previously mentioned, the Community Land Trust is a nonprofit, community-based organization committed to permanent stewardship of valuable housing resources for the community. And that's a very important point that I want to bring up. We will permanently keep this valuable housing resource within our community. And being frustrated over the many years and watching first-time home buyers take the benefit of the increased land assessment, we have seen the first-time homeowner units being lost to the next generation. So that's why so many of us have our children living with us today, because there's no more of that affordable unit available today in our community, which we established 20 years ago. So some community land trusts, unlike the Irvine Community Land Trust, are sponsored and supported by local governments, and others are very much community-based. The land trust model is flexible. It can be used for a variety of purposes like commercial space or community gardens or affordable housing. But in all of these situations, what makes the land trust different is from other affordable housing providers is that the community owns the land, and it enables the development of affordable home ownership. So in the affordable home ownership model, many communities have provided down payment loans that require the funds to be recycled when the homeowner moves. In approaching housing markets, the owner receives only the equity gain, while the community must advance an ever-increasing subsidy amount just to provide more affordable home ownership opportunities. But in the Community Land Trust retention model, you'll see that the subsidy retention means that the funds stay with the home and they create permanent affordability without any additional public or private funds. Homeowners gain the equity based upon the resale formula that restricts the price at which a home is later sold. This affordable home ownership model mutually benefits the home buyers and the communities. It maximizes the public investment, allows for wealth generation, and maintains affordable home ownership opportunities for future California generations. So what makes community land trusts different from other affordable home ownership providers? First, the land trust owns the land underneath the home, while the homeowner owns the home and the leasehold right to that home from the community land trust. The land trust executes a ground lease with the homeowner that spells out all the requirements for the homeowner and for the land trust. The ground lease includes a resale formula and the requirement that the land trust be notified before the homeowner refinances or sells the home. And other typical lease provisions include maintenance provisions, inheritance provisions, property tax provisions. And the ground lease provides the security to the homeowner that it is a very long-term lease, typically 99 years. So that homeowner has that security of having that home in perpetuity should they choose. But generally, the homeowner will have all the rights and responsibilities that any homeowner has in the state of California. The way the land trust ensures affordability over time is that any money, either public or private, that's invested in the project to make a home affordable stays with the land, which is never transferred, and it's never sold by a community land trust. Because the homeowner isn't buying the land, the initial purchase price is more affordable. And the resale formula restricts the price at which the home can later be sold to an amount that the next lower income purchaser can afford. And it's repeated over and over again, and it's accomplished with a single financial investment. And this is important so when public funds are used, you can be assured that your investment creates a permanent affordable housing resource for the state. Now, permanent affordability requires permanent stewardship. Community land trusts are really stewarding three things: the homes, the homeowner, and the public funds permanently. The ongoing stewardship is what makes the model work and what leads to permanent affordability and low foreclosure rates. So many legislators have been concerned about foreclosures and how to address this issue given the downturn in the housing industry. Now, the land trusts steward our properties. The ability to retain them as affordable resource is managed by private nonprofits and is not a burden to the state. Across the country, we found out that land trusts have proven to be extremely successful models of home ownership. The percentage of foreclosure for market rate homes approached 10% between 2008 and 2010. Land trust homeowners averaged about 1.6% foreclosure during the same time frame. So we want to acknowledge that this is significantly below the national average. Now, state housing policy is needed to further this affordable homeownership model. There are 4 areas we hope the legislature will consider in addressing our permanent affordability homeownership policy. Number 1, housing policy is needed to address equitable property taxation, such as when a home are permanently affordable, the homeowners cannot realize the market rate gains in value. So the home should be taxed based on that restricted value and not the unrestricted value of a market rate home. Number 2, the permanent deed restriction, whether public or private, should be acknowledged as restricting a home's value. So currently, assessors will only accept a governmental deed restriction. Community land trusts are working to help communities create a permanent, affordable homeownership resource, and state housing policy could acknowledge private nonprofit deed restrictions as ensuring permanent affordability. And local communities are trying also to create an affordable housing infrastructure, need to have this authority to establish local inclusionary housing ordinances, help them achieve their housing obligations under state housing element law. And 4th, the state housing policy is urgently needed to allow community land trust home buyers the ability to access state-funded home buyer programs. This concludes my remarks, Mr. Chairman, and we thank you for your time. We're open to questions. Thank you.
Thank you very much. Next witness, please.
getting set up here.